This video shows you how to use the feasibility study which is included in the description below. Although it can implicitly help in learning how to set up a feasibility study, if you want to solely learn how to complete such study, please refer to the video in the description. This business plan is for an import trading company. It includes two currencies, but can be one if you set the exchange rate to 1. Other criteria are discussed during the video. It is dynamic and can be used for multiple purposes. Thus, it depends on how you treat the assumptions. Any changes to them will reflect on the whole study. If you have any questions, please send me an email or leave a comment below. Let us have a look at the study. Except for the table of contents, all sheets are linked to at least another sheet. Additionally, we have a hidden sheet for calculations. The first sheet contains the contents of the study. Using macros, we link the buttons to sheets. For example, if we click on the fixed and variable costs, we navigate to that section. Clicking on the top left button takes us back. You choose whether to use it or navigate through sheets using the standard interface. The second sheet contains an overview of the project. The first section is for personal information of the promoter, and the second is for a short description. The third is about key details. The fourth is for market information. The last section is about the feasibility of the project. You don't have to fill this section. It is the result of your study based on the assumptions you make. The assumptions sheet is the most important among all. It allows the dynamics, and derives the result of the study. You can always change your base assumptions and see the effects on the business. If one of the assumptions doesn't meet your case, just set its value to 0. Let's look at each assumption. The startup costs include all the costs you may incur before starting your business. The pre-operational costs and company's registration are intangible assets under the balance sheet. Pre-operational costs are particular acquisition costs in this case. If it doesn't apply to your study, please set the value to 0. You can use the available items for different ones that meet your criteria. You just need to rename them. Kindly note that this doesn't change the way the item is treated in the study. There is place for additional startup costs that will be treated as intangible assets also. The inventory software is an intangible asset as well. The office furniture and distribution car are fixed assets and depreciate according to the rate you specify below. Total startup costs is the sum of the above. Base inventory costs is a calculated costs and can't be changed. It is the total amount of your first year inventory cash purchases minus the purchases you make on account, if any. This amount can be included under the working capital, but we separate them for more dynamics. Working capital is an excess cash that you keep for initial daily and unexpected costs. We need to have the total required start-up funds to start the company. The product information section contains the pricing of your products and the first order quantities. While this study is in dollars, these figures are in euros as the company imports products from Europe. If the currency is the same for your imports, you can set the exchange rate to 1. Additionally, if your products are purchased locally, you set the CIF rate to 0. The selling price is calculated as the CIF cost multiplied by the premium rate plus 1. You can also set this price manually. The minimum order is the quantity you are purchasing of a product in the base year, which is the year you start purchasing the item. You may include an image for each product. You save the images in JPG format in a folder called Images that you locate beside this workbook. You name the image of each product according to each order from 1 to 34. Let us move to the next section. Some countries require a fee for registering your product. It is usually at one standard rate. If you don't have to pay such a fee, you set the registration fee as 0. If you set it to a bigger value, the costs will go under intangible assets in the balance sheet. You have the option to defer the registration of your products to any year of the study's lifetime. Additionally, if you set the registration to registered, it will be treated as none, and no fees will be counted for this product. You can then add it as an additional cost in the startup section in case you already paid for such. You also have to specify when will be the first year you start ordering the item. This is important as it determines your purchases as well as your sales. For example, if we set the base order year to 2 for all available products, we won't have sales in the first year. Moreover, all variable costs that are dependent on sales will drop to 0 as well. The next section states the fixed and variable costs. We have the monthly rents and consultation fee. The insurance cost is calculated based on the inventory. The variable costs are calculated as a percentage of the turnover except for the first one. Samples costs are calculated as a percentage of the yearly purchases, and used for advertisement and promotion of your products. You may change the names, and where it is not applicable, you set it to 0. There is a place for additional costs. Let us move to the next section. First, you have the exchange rate. If your products are purchased using the same currency, you set it to 1. The advantage of having a different currency in case you buy your products in a different currency is that prices are sticky while exchange rates are floating. Thus, you just need to change the exchange rate and not the prices when reviewing the study at a future time. Next, we have the balance sheet items. Accounts payables are calculated as a percentage of goods purchased because we pay for what we buy. Accounts receivables are calculated as a percentage of sales because we receive for what we sell. For both items, there is one rate for the first year and another for the remaining years. This is due to relationship credibility. When you start trading one party, you mostly start with cash and move into credit as your relation develops. Anyways, if you presume credit purchases or using banking credit upfront, you may change the rate during the first year. You can set the same rate for the 5 years. We the depreciation rates for the car and furniture. Next, we have the increase in salaries per year. If you assume no increase, you set it to 0. The value of product license is the value you add to your business if the product is profitable. This assumes you have exclusivity of selling the product. It is calculated as a percentage of the average product yearly profit and is added to your balance sheet as an intangible asset. Think about it like a goodwill. In this section also, we have the figures regarding the sales and orders. The base year order is a percentage of the minimum quantity order you specify above. Usually, you should leave it as 100% since you have a control of your orders in the product information. The first or base year sales is a percentage of your base year order. That is, for product XX1, in the first year, it is 50% of 90,000, which means 45,000 items. The increase in rate of orders is based on which year you start ordering. That is, if you start trading the product in year 3 by setting the order year to year 3, you will buy 100% of the minimum order in that year, and in the 4th year, you will add 25% on top of that base. For example, if you order product XX1 in the 3rd year onward, in this year, you will buy 90,000, and in the 4th year, you buy 112,500. The same concept applies to the increase in sales. As you notice, we have the total of rate increase in 5 years. This is important for sales, because at any time, your sales can't exceed the stocks you have. It can't be more than 100%. Since we have an additional constraint that we give stock out as promotion, sales can't exceed 100% minus the rate of samples. In case it does, no message boxes or prevention codes are put in place. However, it will highlight red for your attention. Note that sales are calculated based on the inventory in hand and not the ordered quantity. To the last box in this section, the discount rate is the rate at which you discount your future cash inflow to calculate the net present value. We move now to the payroll. This table is straightforward. We assume that the rate is inclusive of all other employees' benefits. You can separately calculate the total monthly cost per an employee and include the total in here. We also have the option to hire sales representatives during the second year as sales are expected to boost significantly. If you specify a positive yearly increase in salaries, the increase will affect these new hired representatives during the third year onward. Let us move to the last section on this sheet. We have the option of including existing stocks. The main reason for adding this option is that these stocks are treated differently. They are assumed to be sold during the first 2 years of operations. You can, however, decide on the proportion that will be sold during each year. If you specify it to 60%, then, the remaining 40% will be sold during the second year. If you don't need it, just keep the box at the top unticked. If you tick the box, this inventory will be included in the study. This would normally affect the financial statements. Let us now have a look at the capital structure. The required capital is the total required start-up funds calculated on the assumptions sheet. You have the option to include a loan in your plan. If you desire so, you have to choose on the equity to be invested. Let us set it to 50%. The loan becomes automatically the remaining 50% of the required capital. You can change the interest rate and loan period. The remaining of this feasibility study follows straightforward. We have the balance sheet. This serves as the indicator in case we go wrong. Total assets should be always equal to total liabilities plus total owner's equity. Next, we have the income statement. Then, we have the cash flow statement. Next, we have the investment cash flow statement, which allows us to calculate the net present value among others. If you want to know how these statements are made or more aspects about how a feasibility study is constructed, please refer to the video in the description. Finally, we have the result of our project. If the net present value is positive, our project is feasible. We have the internal rate of return. We also have the standard and discounted payback periods. Finally, we have some financial and accounting ratios for the company. That was all. If you have any questions, please let me know. I hope you find this template useful.